Hello everyone, and welcome to this new video about the RSI. Today, we're going to dive deep into its secrets and learn how to use this indicator properly. So, here's the table of contents for the video. Let's start with the RSI formula. Alright, the Relative Strength Index, or RSI, is a momentum oscillator indicator that measures recent price movements to identify overbought or oversold conditions. This indicator is bounded between 0 and 100. For example, this green area shows that the price is overbought, while this red area means the price is oversold. To calculate the RSI, you use this formula, where U is the average of days closing higher over the period, and D is the average of days closing lower. N is the period of your indicator. Let's now talk about the common interpretation of the RSI. You should know that the default period is 14 because it corresponds to the duration of a half-moon cycle. To have a better view, let's open TradingView and search for RSI. Here we have the Relative Strength Index indicator. If we click on it, we can clearly see that, per default, the period is 14, and this yellow line here is the moving average of the RSI. The traditional interpretation is that if the RSI is above 70, the asset is overbought, which indicates that a reversal might be imminent. So you're supposed to short the asset. On the other hand, if the RSI is below 30, it means the asset is oversold and a reversal is likely, so you should buy. For example, here we have an RSI that dropped to 25, and we can see that the reversal happened just few candles after. But here, we have an overbought signal. In fact, the RSI is above 70, but we can see that the reversal never happened and the uptrend continued. Thus, this indicator is supposed to be a reversal tool, but as we'll see in this video, that's not really the best way to use it. Let's see how to get an edge with the RSI. The first thing you should know is that it's better to follow the trend. In fact, studies have shown that buying when RSI is above 70 is more profitable than buying when RSI is below 30. Here we have the results of the first strategy. You buy when RSI is above 70 and sell after a few days. On the other hand, we have the results of the second strategy. You buy when RSI is below 30 and also sell after a few days. This study was done by the New York Institute of Finance, and as we can see, the win rate is higher with the first strategy, and the average trade size is also better. A really quick example on TradingView. Here we have an RSI at 71. So we can simulate opening a long position at this point. And as we can see, our TP is reached. In comparison, at this level, we have an RSI lower than 30, so it should be a long signal. Let's simulate a buy order. As we can see, it's a loss. So following the trend could be more powerful with RSI than trying to trade reversals. You should also know that crossing the 50 line can signal a new trend ahead. In fact, the 50 line is often underestimated, but it can send very strong signals. I'm talking about this middle line right here. When the RSI crosses above 50, it can signal the start of a new uptrend, while when it crosses below 50, it can signal a new downtrend. Let's see a quick example. Here, we have a cross above the 50 line, and as we can see, it's the beginning of an uptrend. Here, the RSI crosses below the 50 line, and it's a downtrend. At this level, there's a small cross, but it happened over the weekend, so it's not very representative. Then on Monday, there was a new cross with a new trend. Here as well. And so on. And finally, you can use a lower RSI period for reversals. That means, to trade reversals with the RSI, you should use a lower period like 2 or 3. The overbought line should be moved to 95, and the oversold line to 5. As this screenshot shows, the RSI is above 95, and we see a short decline right after. It happens again here and here. But this type of RSI setup should only be used with very low time frames. I mean below 15 minutes. It's really the only way to use the RSI effectively for reversal signals. Okay, now we're going to look at the scalping strategy. It's a strategy based on the RSI 2 indicator, and it's designed for scalpers. Here are the rules. You open a long position if the price is above the 200 EMA, meaning we're in a bullish trend. Then, RSI 2 drops below 5, which means the asset is extremely oversold. We wait for RSI 2 to cross back above 10, and at that point, we place a long order at the close of the candle. We set the stop loss below the recent swing low, and we take profit either when a 1-to-1 risk-reward ratio is reached, or we exit if RSI rises above 75. We use the opposite rules for short positions. Now let's analyze this strategy on TradingView. Let's take an example with the SAC 40 index. We can see that the price is below the 200 EMA, so we'll focus only on short signals. Today, the price opened with the RSI 2 above 95, so we have to wait for the RSI to cross back below 90 to open a short position. The next candle creates that cross, so we open a short position at the close of that candle, which means at the opening of the next one, right here. We place our stop at the previous high and set our take profit to get a 1-to-1 risk-reward ratio. Let's see what happens next. Our take profit is reached. After that, the RSI didn't give a sell signal. But right here, we see the RSI again above 95, so we wait for the cross back below 90, which happens right here. We open the short position, place our SL here, and the take profit there. And as we can see, our take profit is successfully reached again. No other signals for today. This strategy gave 2 sell signals, and both trades were profitable. This strategy could be very powerful for scalpers. Finally, let's talk about the power of divergence. The RSI divergence strategy is when the price moves in one direction, but the RSI moves in the opposite direction, signaling a potential reversal. Here we have a divergence because price drops while RSI rises. And we see that the reversal occurs few candles later. During a divergence, you should always follow the direction of the indicator. Let's see an example on TradingView. First of all, to calculate the divergence, you click here and tick this button. We can see that a divergence appears because we were in a downtrend here with lower highs, while the RSI was in an uptrend. So that signals a potential reversal. Plus, we can spot a change of character right here, meaning that the downtrend is likely over, and we have a breakout of this level. The RSI also confirms that a new bullish trend could be starting, since it has crossed the 50 level. Then we can open a long position at this level, place our stop loss at the previous swing low, and set our take profit to get a risk-reward ratio of 2. And as we can see, our TP is reached. Okay guys, that's the end of the video. I hope you now have a better understanding of how to use the RSI. Thanks a lot, and see you soon for the next video.